All right, so right now we're going to be looking at imbalances. Okay, we're going to be learning about fair value gaps and inefficiencies. So price is the time when price moves too aggressively, leaving an inefficiency in price, right? It's a 3-candle sequence. Candle 1 is the move, initial move, right? Look at that, 3-candle sequence. Candle 1 is an initial move. Candle 2 is an impulsive move with a space between it. And then we have candle 3 right there, right? So to mark out our fair value gap is from, in a bullish scenario, is the wick of the first candle to the bottom wick of the third candle, and in the inefficiency or space between our second candle is our fair value gap. And then in a bearish situation, right, in a sell situation, the wick of the first candle to the top wick of the third candle, and the space between our second candle will be our fair value gap in the bearish direction. Okay. So when it comes to mapping out fair value gaps, one thing I need you to remember, right, is that it does not matter the 3 candles that you start, right? So every 3-candle sequence, let's look at a leg. So right here, we have a price leg, a bullish price leg. We can start counting our 3 from anywhere. So 1, 2, 3. Do we have a space between our second candle? No, we don't. 1, 2, 3. Do we have a space between our second candle? Yes, we do. So then we map out first candle's top, third candle's bottom. We have an inefficiency, and what's that? Price taps into our fair value gap and delivers to an area of liquidity, just like that. So one thing you got to remember is price does 2 things. We fill out inefficiencies. First, we create them, but we fill out inefficiencies and we deliver the liquidity. Okay. So liquidity and imbalances are what move the market, right? Price is always seeking out liquidity, seeking out imbalances. Okay. We continue. So 1, 2, 3. Do we have a gap? No. 1, 2, 3 gap. No. 1, 2, 3 gap. No. 1, 2, 3 gap in the second. No. 1, 2, 3 gap in the second. No. Okay. 1, 2, 3 gap in the second. Yes, we do. We map that out. Boom. Fair value gap. In this case, price does not distribute, but we keep going. Okay. 1, 2, 3 gap in the second. Okay, good. Price distributes, right? Seek out liquidity right there. Okay. 1, 2, 3 price in the gap in the second. No. 1, 2, 3 gap in the second. Yes, we do. Okay. Boom. Draw it out. Fair value gap. So on and so forth. These are obviously bullish situations. And then we have bearish situations right here. Right? 1, 2, 3 gap in the second. No. 1, 2, 3. Do we have any gaps? No. But look at this leg right here, right? 1, 2, 3 gap in the second. Yes, we do. Draw that out. Price retraces that. And what? In this second, we failed to deliver. But guess what though? We took out the imbalance, right? Price just didn't deliver all the way to what? Right here. But like I said in the previous video, we won't be using things like this to measure the delivery of price, right? And obviously this fair value gets mitigated. And it's not like it's going to run there all the time, right? This is just understanding the delivery and inefficiencies of price. Like I said in the Trading with Confluence video, we are taking trades based off of multiple factors, right? So we're not seeing this and slapping on a short just because we see a fair value gap. That's not how it works, right? We need multiple reasons to strengthen our conviction within taking a trade. That is when we actually take a trade, okay? But in this case, the shit would have ran for what, 1 to 1.7. I'm not trying to justify this in any way. It clearly didn't hit, but this is still price seeking out an imbalance. Does that make sense, right? So we are finding an imbalance. We are seeking it out. We do get a mini delivery. We just do not sweep that liquidity point, and that's fair. Okay. So that is how you draw out imbalances. We're expecting the retracement to them and for price to deliver to an area of liquidity. So let's find even more examples, right? So look right here, 3-candle sequence, 1, 2, 3, map out right there to right there. Price mitigates, encroaches this fair value gap, which pretty much means goes into it, right? And then we deliver. So right there, delivery there, or delivery here, depending on how this green candle forms. This is why understanding open, high, low, close of a candle is indeed important. Okay, so as we can see right here, if this green candle opens, goes down first, goes back in here, and then mitigates this gap, then this will be our area of liquidity in which price is then drawing to, right? So price would then be drawing to this wick right here. But if price opens up and goes up first, right, then this would be the draw on liquidity. This would be the liquidity point for this gap right here. Okay, let's find some more examples. Okay, so like right here, 1, 2, 3, we have a gap right here. Price then drops into our gap. And in this case, our liquidity point will be all the way up here, right? Because price is coming in here looking to continue bullish momentum, bullish direction. We would have to take out this wick right here to continue that bullish direction. Okay. Just kind of a couple ways to look at the liquidity at the other end of an imbalance, right? One would just be the highest point of the 3-candle sequence. Another one will be a genuine high and low, right? And then another one will just be the highest point of the move in general. As you can see, before we mitigated this gap, this candle doesn't go in here, right? But instead we put this long wick. Price then comes in here, so we're looking for price to take out this top right there. Okay. Bearish situations. Look right here. We have a gap right here. This one gets inversed, right? So we close above it. We have another one right here. Right, price taps in. So assuming this gap opens up, goes up first, right? Taps in, comes down. But that's not usually what happens, right? Open, high, low, close, like I mentioned before. In green candles, you can expect price to go down first and then push up and then close down. This is what you can expect. And then with red candles, you can expect price to go up first, then go down and then close. Okay. Boom. Here we go right here. Bearish imbalance, right? So with this one right here, this is the candle that's going into it. This is the candle that's mitigating this fair value gap. So our point will be at this bottom right here, right? Because we expect this candle to do what? Push down first. So it's going to give us this low point and then mitigate our fair value gap, and then price distributes back and takes out that liquidity in the market. Okay. So go through your charts, draw this out, map this out, make sure you're actually seeing this, right? Because drawing liquidity, you got to do that as well, right? But the session liquidity gets drawn for you with that indicator. But you also need to find these highs and lows on your own. But liquidity is relatively that. When it comes to imbalances, you got to make sure you're actually identifying these 3-candle patterns. Make sure you're actually seeing them at all times, right? This needs to be like 2 + 2 when it comes to trading, right? You don't need to think about it. You need to just be able to identify them, identify where they're supposed to travel to as well, right? Like I said, it's either going to be the lowest point of the 3-candle sequence, a genuine low in the market, or it's going to be the highest or lowest point of a move before we mitigate the gap. Okay, great. So institutions, they're looking to take their trades at these points, right? Because price is pushing down aggressively, and there are inefficiencies within that, right? So they're waiting for price to pull back into these areas, then they're placing their larger orders, which is then distributing price. Okay. So the best and highest probability fair value gaps are ones that happen in trend after liquidity gets swept during the New York session and the London session as well, as long as ones that take place with a break of structure. Okay, so, and that would just be stacking confluences. We'll get to what break of structure is, but just keep that in mind. So as you can see right here, we're trending down. As you can see, this fair value gap forms and it gets respected, right? Within this trend, we also have another gap right here. This also gets respected, right? This is not a fair value gap on the hourly, right? Maybe on a different time frame. Also, you got to keep that in mind. Higher time frames have higher power when it comes to everything you learn. Fair value gaps, break of structure, liquidity, anything you learn when it comes to trading, the higher the time frame, the more value it has and the more value it holds when it comes to your trading. Okay. Then we gotta talk about mitigated fair value gaps. So what that just means in general is that the fair value gap has been used. Either it got used and it seeked out the external liquidity, or it got inversed, like in this situation, right? So we're gonna say that price did not distribute down, because we're gonna say that this open, high, low, close of this candle is that it opened, went down first, and then went up, which means this gap eventually got closed above with this green candle right there. So if that's how we're going to call a shot, this still counts as a mitigated gap. It means it's already used, which means we're not looking to take price action or take trades from that point anymore, right? So like right here, we're not going to be like, okay, we just mitigated this gap, or we just have this gap right here. And as you can see, yes, price comes back up to that level, but we're not shorting from this, or we're not going to pay attention to this, especially when we start looking at entries for real, because we're going to say that this gap has already been used and price did what it was supposed to do by hunting the liquidity. Okay. So same thing with inverse gaps, right? This gap's already been used. We're not going to wait for price to fall back into this gap and look to buy again or sell again, right? It's already been used right here. It got invalidated. It was no longer a valid gap. End of story. Okay. Cool. So a big mistake that a lot of people talk about is that, or they don't talk about, is that they try to trade every fair value gap, right? So every fair value gap is not an entry. It's not a reason to take a trade. As you can see, this one gets closed above. That's called an inverse gap, right? While ones like this one gets respected and what price ends up delivering to the higher side, right? So not every gap is a gap to take a trade from. You can't ignore the trend. You can't ignore the directional bias, right? Which is very, very important. It's the biggest and the closest thing you're going to have to insider trading is just having a direction for market to travel in the first place, right? You cannot ignore liquidity because liquidity is also going to play a part in giving you that directional bias and letting you know where price wants to go in the first place, okay? Next up, we're going to be talking about balanced price range. I'm going to go ahead and I'm making a new video for it. So we're going to talk about balanced price range next. I'll catch y'all in that one.